value based on 1 year's market fluctuations. So you have about $32 million of unrecognized assets that will be recognized over the next 4 years. So that will dampen, if you will, that apparent 6% increase in the contribution obligation from the 10% to the 16%. So instead of funding the 16.66% contribution rate works off of a market value or an actuarial value of assets that's roughly $32 million less than the market value. But if you were to recognize that immediately, which I'm not recommending, that would drop considerably. The unfunded liability would drop from 40 million to 8 million. And you'd have a very, very different amortization cost. But we like the concept of smoothing asset values so you don't have big swings from 1 year to the next in contribution rates. So by phasing in that number, you shouldn't see the 16.66%. You'll see something significantly lower as those excess gains, if you will, are recognized. And you can see that on, there's 3 pages.
No, page 25.
Page 25, where without going into a lot of detail, we show the last 4 years of asset values, contributions, benefit payments, expected return and actual return. Last year, for example, you had $21 million more than the 8% assumed rate of return would have generated. So that last column, totaling $31.5 million, will get phased in over the next 4 years to offset what looked like a very dramatic increase in the numbers, the percentages I showed you earlier. You want to go further?
Questions on the board at this point?
So in a 4-year period, the actual investment returns were 17 million, almost 18, well, $17 million greater.
I'm sorry.
From 33 to 51.
I'm sorry, what are you looking at?
I'm on page 25. It says your actual investment return in 2004 was 33.8 million, and in 2007 it was almost 51 million.
That's 1 year's excess return. That's not a cumulative number. So in that 2004 year, you earned $15.9 million more than the 8% return would have predicted. And we've carried that into the assets in 20% increments over the last 4 years, such that you only have $3 million left unrecognized.
I guess
I'm reading across that top line.
Yeah, I'm not an expert in this. I'm not even a novice at this, but it just seems to me that when the investment return in the retirement system is accumulating that much money, why would the contributor, the county, the payroll, the employer, why would we have to be increasing? It seems to me like that would take care of decrease your actuarial deficit, I guess what you call it, your unfunded liability. It seemed to me like when you have that much excess revenues coming in, that would,
well,
we've
seen 4 years.
To put it bluntly, I don't know why we need to contribute more money to the retirement system. $400,000 more is, in our struggling times, is a lot, when the retirement system, in my opinion, is the revenues in it when you're increasing that much in net assets, why do we need to contribute more? It is Mendocino County's retirement system, and we all want to keep it sound, but there's a limit to how much they really need to keep it sound. To be 90% funded on your unfunded liability that's probably, as far as the retirement system statewide, that's in the top category, isn't it?
Probably not at this point because of the market returns of the last couple of years.
You're saying CalPERS is better?
I don't know about CalPERS. I know LA County is better, and they use a smoothing technique as well. What you'd wind up doing, if you were to recognize all these gains this year and drop your contribution down to 10% or keep it at 10%, is that next year it would jump up if the market performed poorly this year. So by doing this, what we're trying to do is smooth costs rather than minimize costs after good years and see them shoot up after bad years.
If I could interject something about the 5-year smoothing, there was a time back in the late 90s and in the like 2001 and 2, a little bit, the smoothing that we do, this 5-year smoothing of our gains and losses, allows us to use funds in what I call our unrecognized returns on our investments to pay for health insurance if we need that during years that we don't earn enough to pay for have any excess earnings to pay for health insurance. And once we adopted this 5-year smoothing, I think Harold could say we're stuck with it for quite a while. It's hard to get out of using a 5-year smoothing because the IRS makes it so onerous that it actually penalizes you to opt out of a 5-year smoothing. So we're really stuck to using this. It benefited us in times when we were showing losses on our return. It's now coming back where it isn't benefiting us as much or at all, but we really can't get out of it at this time. What you recognize, Harold touched on a minute ago, is we're almost 98% funded on a market value basis, but because of the approach that we've taken of adopting this 5-year smoothing, we can't use a market value at this point in time.
Well,
And if you look at the contribution numbers that I referred to earlier, they'd be pretty flat, continuing the averaging, the 5-year smoothing, and the old funding agreement. So that should be something you want as well, a predictability of the contribution rate, and not have it go to 16 million in one year and 9 million the next, and then back up to 16.
well,
So there is a trade-off there.
yeah,
You know,
I understand that. I guess my point is, in the last few years, the county borrowed the 90 million and put it in a retirement system, and the retirement system was able to invest that basically since that was done at a double-digit return. And now it seems like because that was a prudent decision to do, it seems to me like that the county should see the benefit of that. But what we're seeing is well, we want to jump it up and go for more soundness. And $400,000, that's a lot of money when you're talking about funding a library, of keeping the doors open for $40,000 or not keeping the doors open or something. So $400,000, if the retirement system needed it to stay actuarially sound, of course it'd be a no-brainer. But I just wonder how good a financial shape the retirement system has to be and how much more we have to raise our contribution rate to keep it. We all want to keep it sound. There's no doubt about that. But I just feel that there is a limit of how we can increase our contributions. That's kind of a third grader's approach to this whole issue. Maybe I don't see everything.
Thank you, Supervisor. Supervisor Smith?
Thank you, Mr. Chair. This is actually a discussion, and I believe it was to some degree at least referenced in the actuarial report last year, but it is a discussion that we had at the board level to sort of bring this concept forward, even though it wasn't the recommendation at the time to have the rate reflect the discussion, but we all knew that it was coming, and I think we talked about the executive office preparing for this. But I think perhaps it would be good to have a little bit more background, and probably Mr. Knudson's the best person to do this, in terms of what we're talking about funding here and whose responsibility it is to fund. I mean,